Hello and welcome to another episode of Nothing Ventured with me, Ari Shah. Today in the studio with me, I had Irena Spazzapan. Irena is managing partner at Systemic Capital, a VC fund spun out of the global climate advisory firm Systemic. After cutting her teeth at Goldman Sachs in power and commodities, Irena moved into venture, building Systemic Capital to back tech founders solving planet-scale problems, tackling decarbonisation, electrification, industrial biotech, and next-gen computing. She's a realist about where climate solutions need to go, favouring software-first, asset-light approaches over heavy capex models. In this episode, we talk about how VC has been a story of the deregulated world.
Internet, mobile, e-commerce, all that. We focus on the physical side of software. And as soon as you touch upon the physical world, the world becomes very regulated.
Wild nature versus engineered nature, where the VCs continue to hide behind power law.
I guess my point is that power law is, it's irrefutable. Yeah, this is an industry that will always work on power laws. But it doesn't mean that you just sit there and wait for, your two companies to IPO. And then you hope for the best.
How taking a proactive approach to exiting the middle ground of companies can only be helpful, and how $7 trillion in money markets may well need to find a home if interest rates come down.
In the past 5 years, 10 years, right? It was Max 7 forever. That was the one trade. Max 7 are not returning that money. And so, so if that money starts leaving money markets, it will look for where's the next growth.
Why you can't win a generalist game against US Tier 1 funds, and how specialist funds tend to be publicly funded in Europe.
But that means that you have locally very strong funds, right? And so there's less of a reason for us to be, invest a ton of resources to be in a particular ecosystem. You want to penetrate the Berlin ecosystem, the Paris ecosystem. It's not hard. You can do it, but it takes time.
How fundamentally VC is still a boys' club.
As an outsider and as a woman, you can do better than some of these, traditional boys that have all been doing the same things. For me personally, is a huge source of motivation.
And much more. Let's get straight into it. Hey guys, whilst I've got you for on, if you enjoy the podcast, we'd really appreciate it if you can like, comment, rate, and share. It really helps us spread the word. And of course, if there's anything you'd like to talk to me about, whether it's about the podcast or anything else, do connect with me on LinkedIn or Twitter. I'm always up for a bit of a chat. Right, let's get back straight into it. Irena, really great to have you in the studio with me. Thank you so much for joining.
Yeah, it's a pleasure. It's good to explore a different part of London.
Yeah, no, it's quite nice up here in the suburbs. But look, let's get sort of stuck in. I want to explore a bit about macro and venture, which you and I have actually talked about a little bit as well. You're kind of vocal about the importance of macroeconomics in venture, but why do you think so many VCs neglect that sort of a lens, and what are they missing? Given kind of current market volatility, tightening liquidity, how should early stage climate tech or even, just more general sort of tech startups position themselves?
Yeah, look, I think the story of venture capital of the past 20 years has been very much a story of the deregulated world, which is internet, mobile, e-commerce, all that. We focus on the physical side of software. And as soon as you touch upon the physical world, the world becomes very regulated. And whilst we don't touch regulations, we don't back subsidies, any of that stuff. The moment when you touch the physical world, then the macro really, really does matter. It matters where you are in the interest rate cycle, which is, for example, one of the reasons why capex-heavy companies have been just about the worst possible investment, certainly in our areas of interest.
Look great 6 years ago, but 2 years ago, completely.
And you have a 10-year horizon. You can't just take a bet on whatever is going to happen tomorrow. Equally, tariffs obviously have been front and center, but, that maybe it has been less relevant and hopefully will be less relevant in the future. But all of this macro, whether it's interest rates and what it does to the cycle, what happens with tariffs, what happens with monetary policy, what happens with, these sort of broader fiscal issues that so many of the Western governments have, it's kind of central to, certainly if you have a physical lens like we do, it's possibly central in other areas. Certainly if you're crypto investors, that stuff matters too. But it's not been traditionally part of the VC kind of toolkit, And I'm certainly excited that we've been using those tools over the years, and that's also why I think our portfolio has done well.
Yeah. So a couple of things I wanted to kind of dig into. So first of all, you talk about this kind of interaction between the physical world and software. Can you explain that in a way that maybe with a couple of examples of what that actually means, right? Because in my mind, I'm thinking, okay, software in manufacturing businesses, or software that is battery tech, for example, right? But what is it that you mean
all of that.
systemic? Yeah.
It's obviously a very broad field, but I think if we try to sort of narrow it down, so in the first, electrification, that's any platform or software-based system that works towards electrification of transport, of heating, of buildings, and so on, industry, and so on and so forth. We will never back, capex heavy, new chemistry of a battery, new electrolyzer. We don't do that kind of stuff. We're looking much more into platforms that bring all these things together. Sometimes they sit more on fintech, sometimes they sit more in SaaS, sometimes they sit more in, software-enabled hardware, right? They sort of take different business models, but that's one. The coding nature, that's much more so the world of chemicals. Sometimes it touches upon pharma, certainly the world of agriculture. Yeah, we call it the wild nature and the sort of engineered nature, which is the agriculture world. And then the physical AI, the kind of applied AI world is much more the buildings and fleets and industries and how you bring intelligence to sectors that have previously been more in data deserts, right? And now with AI, it becomes possible to have a much, much smarter way of operation.
Yeah, I mean, it feels like I had someone on the podcast last year from OSS Ventures, right? And his whole, I mean, he it's an accelerator incubator type setup, and it all sprung from him having been in a Tesla factory and just realizing this is the future of manufacturing. And when you think about Europe, one of the metrics that he gave me was not just Europe, but globally, 50% of people are employed in physical operations, right?
Yeah.
And I think
and most are in small companies.
Yeah, and 30% of GDP is generated in
100%,
these industries.
And small companies have less resources to go and spend big on, automation and robots, and AI is unblocking all that. And even, automation with robotics, which is the thing that is coming next, that is now at a cost curve that would have been impossible, even 5 years ago for SMEs, which is where the majority of actually people in the West are employed. So that is all of, I would say the only physical world that is not something we do is space. Yeah.
Yet, maybe.
Maybe. I mean, there are parts of space, that are definitely applicable to, sort of planet scale solutions, which is what we look at. Yeah. It's, there are different reasons why those business models are harder, but yeah.
Yeah, I know. There's a couple we're talking to at the moment, which are super interesting, but I mean, I just wouldn't have even thought about them as applications.
Yeah, and I think we as a team very much come from those industries, from different shapes, not necessarily like, the sort of big corporate or stuff like that. But, I spend more than 10 years of my life walking around power stations and control rooms and figuring out how all these electrons actually come together. And my colleagues have done similar things in, the other industries. And I think that really brings us an angle where we can go very deep and be very helpful with founders, especially when it comes to introductions and help them to navigate those ecosystems.
Yeah, it's very different when you walk with a hard hat on, having done that quite a lot in my life as well. But going back to that question on the macro, right? So one of the things that I think seems to be the case is venture, and certainly over the last several years, has operated in this kind of we're one step removed from what's happening in the world because of, the sort of timescales of venture typically deploys over, the long-term sort of event horizon. But but we saw it very clearly having a massive impact, right? So in 22, when interest rates rose, flight of capital from venture, LPs starting to, see, oh, well, I can actually make good returns, less risk. Why would I go into this asset class? So it kind of feels like fundamentally, yes, VCs should be paying attention to these macro kind of shifts. But even in their deployment cycles, exactly to your point, you can't take if it's okay for the next 3 years, that's fine. But what happens in 10 years? You've got to be investing.
Well, you will never have, you'll never have a view on 10 years. I mean, you can have a very blurred, right? In the end of the day, you back companies, they will need to be able to raise money in the next 2 years. That is absolutely critical. And I think that's very much the view we take. Yeah, it's like in the next 2, 3, 4 years, why would this company not be able to go and raise again? And there, the macro actually does matter a lot.
Yeah. What and would you say there's like one thing that you're seeing at the moment that people aren't paying enough attention to? Is there something that might be a little bit kind of left field coming around the corner over the next year or so? I mean, none of us saw tariffs, or we kind of did.
Who knows? I do. I think certainly. We are, since 2008, 2009, the great financial crisis, there has been unrest, and I think I'll call it social unrest, which has materialized with all this populism, right, and all the troubles which we all see around us. At some point, historically, this ends, and then you have something that creates a new order, a new social political order, which is kind of difficult to see right now. We are still in this kind of noise, and right. And so, of course, that chasm historically has been war.
Yeah. I was literally going to say,
right?
Feels like war,
and
isn't
so,
it? Yeah.
That's the kind of topic that nobody wants to talk about because it's, it's not a scenario that you'd ever want, but it is a very probable scenario, hopefully not, not in your backyard and, who knows, but, to an extent, it's already happening.
But to the extent it's already happening, it has actually had a very clear impact on venture because you're seeing more dollars flowing into defense tech, right? As an example.
Absolutely. We are not going to do defense, right? We don't like selling to governments. And so defense fall in that bucket, which, there's all sorts of reasons why we don't like, which is also why space for us has always been so hard because it's mainly selling to government. Yeah. But yes, the only way to avoid war in Europe fundamentally is to rearm, but of course, once you have a lot of arms sitting there, then you will be very tempted to use them. But that's the big wild swan out there is that. There's a famous book called The Fourth Turning, which I read, during the financial crisis, actually 20 years ago. It's kind of this, it's not scientific at all. It talks about these 80-year generations where, if you look at it mainly follows the Western world, and you go back 300 years and at the end of every generation, people forget. And then you have a 20-year uphill. But it's interesting because, 2008, 2009, that in that book written, whatever, that's kind of where this next period started. And historically, these were 20-year periods, So, look, that is not scientific at all. But I think it is very possible that, in the next, 5, 10 years, something like that, there will be... I'm actually really excited about what this new order will look like.
Yeah, interesting. Yeah.
Because it's a new order that will essentially take us to a world where we have massive population shrinking.
Yes.
AI everywhere, automation everywhere, which we need because we're not going to have enough workers.
Yeah.
Now the question, of course, if you can keep all the people that want to come in out, because that's kind of, it comes with it. But they are, it's such a massive societal shift.
Yeah.
And, I think we are all very much hoping that it's going to be a soft landing into that new order.
Yeah, but I'm not convinced about that.
But that is the big blue swan, black swan out there, which I think, we should all have in mind.
Yeah.
Because, it's just unpredictable,
and exactly that. Like it's not, like, to an extent, it's not even a black swan because it's known. It's just the timing.
It's the timing
and the depth and the kind of extent of it is unknown. And of course, if you listen to, Elon Musk will have one view, for example. Bankers will have another opinion. Jamie Dimon, will say something completely different or whatever, right? And the problem is, because there's no consensus around amongst the experts, for the average man on the street, they're kind of like, well, they don't know what they don't know what's going to happen, so I'm just carrying on.
In the meantime, I just want my goodies and that's it. But I think if you are in the world of technology, you can see what is on the other side. It's not that hard to see what is actually on the other side. It's just how you get there, what it will take for us to societally accept it and get there.
So it was interesting, just as a random kind of side topic. I was at a family office dinner several months ago, and I was talking to this guy. I think he was a sort of family office principal. No, sorry, not a principal. He was a family office executive. And he was like, look, let's do this thought experiment. I've asked lots of people this question. I would love to get your feeling on it. And he goes, at what point do you think you're going to have a robotic football team able to beat a human team? And
have you seen it in China? Have you seen the
exactly? So this is the thing, right? So most people were saying 2035 to 2045, and I was like, no, I reckon it's 2028 to 2032. That sort of a time frame, or 2035 at the outside, right? And he's like, oh wow, you're like way more kind of bullish on this happening than other people. I'm like, yeah, because you can see it happening. And actually just the week after, or the week after, a couple of weeks after that, the videos of the China robot, both the football, but also the guy doing the Kung Fu hustle dance,
the dancers,
and all of that stuff started coming out. I was like, look, we're here. So I actually am maybe 2 years too late in my anticipation. But I mean, Okay.
But again, it's a function of understanding the macro. Yeah, the reason why China is miles ahead is because the government, pursued, right. We still cannot have. It's still very difficult to have drone deliveries.
Yep.
It's still very difficult to get these dark factories here that they have in China. So there's a regulatory reason why they're ahead. And again, it's about. You want to look at the future, go to China, yeah.
So this is the thing, and again, I mean, this wasn't meant to be a China podcast, but I really appreciate that you said that, because, I mean, I've spent a fair amount of time in China, right? Both as a buyer, as a buyer and as a seller, but I remember getting off, getting off the plane in Shanghai and hitting the motorway, and it's just like 5-lane, whatever it was, incredibly well lit, incredibly well.
And you can hear the birds because all the cars are electric.
Exactly. Well, at that time, no, right? So the last time, this time would have been in 2016 or something along those lines. So we're a little while away from that. But the thing that really annoys me and aggravates me is like all of the rhetoric, certainly from the US, if not from elsewhere, is China's still behind. They still steal our technology. They don't have any advancements of their own. And I just think, well, go and look at the BYD. Go and look at, like, I remember at the time I was working in the edtech business. Their edtech was leaps and bounds ahead of anything that the West had produced. What they didn't have was content to feed the edtech necessarily.
Yeah, because software is not, in China, they're not very good. I mean, they're not as good on software.
Yeah.
But, again, the hope is that Europe manages to thread this by somehow staying in the middle.
Yeah.
Yeah, and that is not difficult because the Americans will just want to sell their compute.
Yeah.
And, I don't see us buying Chinese compute, but, maybe there's some kind of world where you can get on with more and more European, American, and then Chinese hardware, and that would be the win-win for Europe.
Yeah.
But that's not going to be easy, yeah?
Yeah.
But I don't really see another way how Europe goes through this.
Because the problem with Europe, I guess, from that, and again, not to get overly political, is 27 fragmented government, like there isn't one,
no, it's true. But when disaster stacks, they usually get together.
Which is what happened recently. Obviously, they, defense spend, etc., etc. They've come.
Yeah. So it's not. I would also say that the base case is not optimistic, but there is not immaterial tail risk that they will actually get it right.
Yeah. Anyway, look, again, I think we could spend a podcast on this. So, I also, because the other thing that you and I talked about was this whole kind of question around power law versus sort of discipline, looking at exits, right? Because we all know, right? Everyone talks about and loves to talk about power law in VC, right? And I would argue that potentially lots of founders don't necessarily grasp what it actually means. I think most VCs understand it, but also kind of overplay it maybe. But you're really clear that you can't hide behind the power law, right? So why is that kind of wait and hope for an outlier strategy so dangerous? And what practical steps do you think can VC firms take to really build out genuine discipline around exits?
Yeah, and look, that's obviously linked to the fact that DPI in our industry has been, has disappeared
negligible to say the least.
In the past 5 years. We've actually had 5 exits since we started 7 years ago. So, I guess my point is that power law is, it's irrefutable. Yeah, this is an industry that will always work on power laws, but it doesn't mean that you just sit there and wait for your 2 companies to IPO, and then you hope for the best. Yeah, you also have to somehow plan for the worst. Yeah,
and especially in a world where private access to private capital continues to be like extraordinarily easy. So, founders take longer to exit because they can take off as secondaries.
Absolutely. So, there are 2 actually, if you have a company that you genuinely believe it's a rocket ship, you shouldn't sell until IPO. Yeah. But again, it has to be a rocket ship within kind of 10 plus 2, 10 plus 5 at best, kind of term. Yeah. If you have a rocket ship that will take another 20 years to exit, that doesn't work. You have to, right? But then you also have this other, I think in VC we tend to divide our companies, internally, but you tend to divide your companies in the rocket ships. You have the kind of maybe we don't know, and then you have the oh my god, that's not
why
right?
Why do we do this?
And I think often the rocket ships are the one that need the least of your help. Yeah, these tend to be founders where you will try to help them, but or they kind of know where they're going. And then, so the danger is that you then spend, all of your time in kind of, and so you have to be very careful with that.
Yeah.
But I think in my experience, within 2 years, you'll know where this company, look, there will always be surprises, but usually within 2 years, you will know if this company is going to be, a zero, a something, single multiples, or it's going to do really well. And if you see that it's a company that actually has a technology, has a market, has some kind of distribution that is really valuable, but they're just not going to make it in the VC, kind of time scale, then I think it's your responsibility as an investor to go and find a better home for that company. Yeah. And that might lead to, a 1x, a 2x, a 3x, whatever it might be. But at least that company then goes on. The founders don't have to deal with the incredibly painful issue of, firing everyone and closing down, right? And those you can see in advance. Yeah. So when you have a company that still has maybe years of cash flows, that's the time to do it.
Yeah.
And so I guess that's all I mean, is that, it's not just good enough to sit there and wait for your, 2 out of whatever, 20, 30 companies to go and keep promising this, exits, which is always 5 years away. Yeah. But you also have to work on creating DPI with that kind of middle pack.
Yeah, I mean, there's a few points that come out of this. So again, for the audience that hasn't yet heard the term, DPI is distribution to paid in. So it's the amount of money returned to LPs off their original investment, right? And the reason we talk about it a lot, I guess, in venture is because it is important, right? You are always looking to return multiples of capital back to LPs. So there's a couple of things, right? So firstly, I always think about these kind of measures of performance within venture, right? And like there was a time where I was like, IRR is kind of irrelevant. It only matters how many dollars you return. And then I was like, well, hold on a second, actually, but time value of money. So actually IRR is kind of important, especially where companies are taking longer to exit. So actually, like, one of the thought process I had, and obviously, I haven't properly done the maths on this, right? But an investor could have a much better IRR by exiting or helping a company exit at 2, 3, 4x early on than waiting the 15 years for an IPO at maybe 10, 20x, right?
I cannot agree more, but that is not the norm in venture.
Yeah.
The venture industry functions by multiples.
Yeah.
And so having a 10x in 15 years is for whatever reason better than having a 3x in 3 years, which mathematically is not correct. Yeah. You and I are not going to change that, but I think
we can try.
But I think LPs, but I certainly do think that LPs, that would be the investors, the limited partners, are more and more focused on this point. Yeah, because pushing all this in the future, eventually is just not going to be conducive to any kind of growth.
And especially when forgetting even kind of time value and IRR, literally no dollars are flowing back to LPs. Like the DPI has crashed significantly over the last several. I mean, someone's telling me about a 2015 vintage fund that has literally not returned $1.
Yeah, but that must be like a very low performer. If you're in the top quartile, then that should not really be the case.
No, of course.
But there's many reasons why this could change. You have $7 trillion sitting in dollar money markets, right? If interest rates go down, that money will need to find a home somewhere else. And it will be in equity. And I guess in the past 5 years, 10 years, right? It was Max 7 forever. That was the one trade. Max 7 are not returning that money. And so, so if that money starts leaving money markets, it will look for where's the next growth.
Yeah.
Still in asset-light businesses or, primarily asset-light businesses, because you could argue that the Max 7 businesses are definitely not asset-light businesses anymore.
No.
Yeah, they are like...
Well, they're all compute centers,
They are, exactly, right? They are spending CapEx like there's no tomorrow.
Yeah.
And so there's a massive opportunity in venture here, right? Because these kind of next 100 companies that are generating, the 20, 30% annual growth typically come from venture. But you're not going to see that until interest rates come down, and I think you can perfectly make the case that interest rates are not going to come down. It doesn't again, mathematically, it doesn't quite make sense because inflation is so much lower now than interest rates. But at some point, there is an argument which you could make that we are coming to an end of this kind of, bearish 5-year cycle where there was just no liquidity, because there's a real reason, right, why the markets will be realigning. Yeah.
No, I mean, interest rates have come down a little bit, certainly in the UK.
In Europe they have, but in the US not so much.
Yeah, in the US less so.
And when it comes to IPOs, there is really one game in town. Yeah, nobody's going to IPO in Europe anymore.
Yeah, that's the conversation that we have time and time again on this podcast. And it so frustrates me. I'm like, the wise delisting, like all of this stuff. You know, we sit here, you know, in the UK especially, we talk about becoming the next AI powerhouse or whatever it is. Meanwhile, we've had Nvidia just, you know, come close to $4 trillion in market cap,
sure.
right? You can't see that. Like, I mean, I think even with the founders that I know, the VCs that I know, they're hugely optimistic. Like at the same time, the tell is that no one is saying but IPO in Europe, right? No one is saying IPO in the UK. Everyone is saying, well, if you're gonna IPO in the US. And yes, there are some structural reasons behind that. But I think what it comes down to, and again, this is a conversation, you know, you're from Italy, and I've had this conversation with a number of Italian VCs as well. Europe, most generally, like public investors just don't have the same optimism or attitude towards tech.
That's definitely an attitude, but there, you know, there's also like some very simple tweaks, which we
pensions,
have a stamp duty here. Like, every trade has that's ridiculous, right? Yeah. And again, it's whatever, 3-4 billion to exchequer they don't want to let go. And where do you go? You go London, you go Amsterdam, you go Paris, you go Milan, you go whatever, Frankfurt, whatever. It's massively fragmented. That doesn't make any sense, right? But yeah, you know, from that perspective, Brexit was the best deal for the US because, you know, it kind of sucked the liquidity out of London. It went into all these little capitals. Yeah. And then the US dominated again. Yeah. Right? So...
I don't want to talk about Brexit either. It's so depressing. But no, look, I think, you know, one of the things that, and obviously I work on the other side of the table within these sort of companies, within these startups, you know, our CFOs are often in the midst of some of these messy transactions, trying to make sure they make payroll, right? Trying to make sure that the next round does get raised, or looking for that exit opportunity, right? And what I'm hearing actually a lot more from VCs, and I think this is a positive trend, and it's very much sort of along the lines of what you've just talked about, is not banking on those 1-2 outlier outcomes, potentially building much more stable, profitable, large portfolio, or not large, but portfolios of companies that are value accretive, are value generative. So we had Hannah Mayton from Ampli Capital on the podcast, you know, small firm in Sweden. And, you know, she said, we're not looking to back, you know, they're SaaS focused. You know, she's like, we're not looking to back the 10 to get the one unicorn. We want all 10 of those to be great outcomes, you know, but they're not necessarily individually fund returners, right? Now, I think...
Sure, that's called private equity.
Yeah, it is. But doing it at the earlier stage.
It's difficult to play that game, you know, when you invest, the company is loss-making.
Yeah, exactly.
So, yeah, you have to be careful. I do believe that if you are in venture, there's no way out of than power law, right? There's right, because
you've got to bank on it. Yeah.
You cannot say, oh, I'm going to back, you know, 20 companies and my base case is that each one returns to 3x.
Yeah.
You're not going to, there will be no return in a fund like that.
Got it.
But you still have to make sure that, you
still help those
every single investment we underwrite, we need to see at 10x. You know, like, of course, we're going to get it wrong
opportunity
half the time, but we need to
to
see a TAM and, you know, a opportunity big enough to get to at least a 10x. We're going to get it wrong half of the time or more, right? But then doesn't mean that we're still not going to work hard to go and find those, you know, 1, 2, 3, 4 X's, you know, in the middle.
When it doesn't turn out the way you would have hoped it would.
Yeah, or when it takes longer than you thought.
Yeah. No, I mean, I think we're going to see a lot of that in any case. I think, you know, because there's a whole swathe of companies probably, you know, that started being built pre sort of 2022 and pre the kind of AI hype cycle, etc., which, you know, were very generalist SaaS or maybe something along those lines, got to kind of maybe 7, 8, 10 million in ARR, but are now kind of struggling to find where next. And those are the sort of companies where, you know, to your point, you're going to have to try and help them because, yes, they could be profitable. They could be actually decent companies. They're not going to be fund returners, but they are going to be valuable to someone, right? So the other thing that, you know, we'd spoken about when we first talked was your kind of approach to transatlanticism, right, and your strategy. You've kind of deliberately focused on the UK-US corridor, and predominantly sort of avoided continental Europe. So can you just walk me through the rationale there?
Yeah.
Is it kind of purely opportunity driven or something more structural? And with the US increasingly eyeing Europe as an expansion market, right? We've seen lots of firms coming into Europe, cheaper, better pricing, et cetera, as well as the fact that, let's face it, like our talent here is 10x cheaper or whatever it is. It's absolutely crazy. How should European funds and startups position themselves to leverage that trend? And especially as we tend to think about this aspect through a Europe to US lens rather than vice versa.
Look, if you play the generalist game, which is, I guess, the majority of the VCs, certainly in London, that becomes really, really difficult, right? Because you're not gonna win a generalist game against the US tier 1 funds, right? It's just a non-starter. We are a specialist fund. We go very deep. We have these areas of interest, and so I think our pitch, if you want, to founders is a little bit different. Yeah, it's not just the reputation as opposed to the big name or the big check. You really kind of want to offer your deep networks and your reputation within a particular industry, right? Which is much harder for journalists. And so because we are a specialist and we track our TAM, our TAM, we published a paper recently about that. Our TAM is about 5 billion. It's been kind of consistent since 2022 when the markets corrected. And for our TAM, we see the majority of the opportunities, in the UK, US. Of course, there's also stuff in Europe, but where? Germany, France, Italy, Spain, it is so much more efficient for us to be,
one corridor
on the corridor than to like 5 others. That's the main, which is an efficiency, productivity reason. The second reason is that, these specialist funds in Europe that look after similar problems or, opportunities than us, tend to be publicly funded in Europe.
Okay.
EIF and all these various agencies that you have in every country. We so far have no public money, so I think we've been absolutely free to sort of stay 50-50.
And I guess your point there often is that often these publicly backed funds.
But it's the
have
majority.
A regional, but they also have a regional obligation.
Oh yeah. You basically have 80%. Yeah. You have to invest. I don't know if it were in the European Union or your country. I'm not quite sure exactly how.
Yeah.
But that means that you have locally very strong funds, right? And so there's less of a reason for us to be, invest a ton of resources to be in a particular ecosystem. You want to penetrate the Berlin ecosystem, the Paris ecosystem. It's not hard. You can do it, but it takes time, right? And for us as a small team, it makes no sense. We are much more efficient playing one corridor.
I think and again, I mean, it also goes back to what we were talking about earlier, right? Like UK-US corridor makes sense because again, that's where yes, the market is, yes, the exit opportunities are, etc. And I think what's interesting to me is that Europe, I think, currently only attracts about 5% of venture capital, right? So outside of the UK, right? The UK punches above its weight very clearly. And there's, I mean, we've had a ton of investors from Europe, be it Italy, be it the Scandies, be it Turkey, elsewhere. But the one goal is always how do we get to the UK and from the UK to the US, or how do we even,
Well, it depends also on your companies. Yeah, and I would say if I look at our companies, we have almost 30 companies. There are very few exceptions of companies that actually are not UK, US already.
Right.
Most do it very early on. And so again, we can help because you have a particular ecosystem. We never lead in the US, right? At best we'll co-lead, but there's a whole ecosystem of people we invest closely with, which means that then when you're European, when your UK company wants to go there and they need to raise a round, you know who to go to, you can help them, right? So yeah, it's really a productivity. It's efficient. I don't think it's an issue of there's a ton of great opportunities in Europe, and when stuff comes to us, we'll look at it. We will just actively spend time.
You aren't going out hunting, but
no.
if you get inbound, of course.
Sure, we'll look at this. If it's in scope, we'll look at this.
Yeah.
Again, it would have to be something where we can really meaningfully lean in for us to do a deal in continental Europe, which we have. We're not going to do like a random. It has to be something where we can really help. Yeah.
And this sort of question around US firms coming into Europe, is that a net positive, do you think? I mean, does that crowd out?
Again, for us as a specialist, it doesn't, I've seen over the years, I've seen plenty of generalist funds that have made silly investments in our specialist areas, right? Because they apply a different lens or
it's a bandwagon.
And they often want a specialist in the mix, right? Because they will, maybe it's an area they don't know as much, right? And so if you are happy to be a meaningful follower, then it's okay. You can work with them.
Yeah. No, look, I mean, again, all makes sense. And I think it is a recurring theme on this podcast. I think UK investors, and it's similar to, like, they maybe don't express it in the same way, but it's essentially there is so much deal flow that is available in the UK
That's
or
right.
in the corridor, right? That actually somewhat diluting attention and focus. And again, to your point, with a small team, like if you have a larger team or you can set up satellite offices or whatever, maybe it's more, it's more feasible. But then you get the problem of at what point, at the moment, Systemic is 140 million AUM. In order to have that sort of expansion, you need to grow to kind of...
Oh, you need to be above 500 million.
Yeah, 500 million plus, right? Which changes the game, because then you're no longer able to operate necessarily at A, B. You need to start looking at B, C, D.
Oh, yeah,
right?
sure. But it depends what size. Again, we are very disciplined. You have to look at the size of your TAM.
Yeah.
If I know our TAM is 5 billion across the geographies and everything we invest in, the size and everything. So... maybe you could have a 200 million fund. Maybe even that would be because then the conversion ratio becomes crazy. You start doing silly deals. Or then, you see funds that start doing deals in whatever, Nigeria, India. It's like, really, what do you know about those jurisdictions? And so if you want to grow your TAM, you can then, start hiring new GPs that can then look into adjacent areas. But it's really or you keep a consistent strategy. Yeah. And maybe over time you then raise a different strategy under the same platform. If you can justify that the platform, has multiple advantages. But I think the idea that you're just going to raise a bigger fund for the sake of raising a bigger fund is going to inevitably lead to disaster.
Yeah. And again, I think that seems to be the sort of thing I'm hearing and seeing a lot of, right? Like, I mean, apart from anything else, I think emerging managers are struggling to raise even Fund 1, over the last couple of years. And it's this really, it's this really interesting dynamic, because a 20 million, 30 million Fund 1, like, how do you pay the bills? 100, 150, 200 million fund 2. Yeah, okay, that's cool. And there's
it's like we were, I will be always eternally grateful. Our Fund 1 only got off the ground because we were incubated within Systemic. It would not have been possible with the fees we had from Fund 1 to sustain a team. And then with Fund 2, we were then able to, let spin out and go solo. But otherwise, that's why the barriers of entry to, it's not just VC, asset management in general are really, really high. Yeah,
I've noticed. When talking about barriers to entry, right? So, let's talk a little bit about women in venture and kind of herd mentality, right? So despite the very clear financial case for diverse viewpoints, venture remains kind of stubbornly undiverse, right? However much we all talk about it, however much we have diversity VC, included VC, all of these sort of platforms and communities that have grown over the last several years. But from your experience, what's actually blocking progress, right? Because we've also seen talented women leaders exit the VC industry entirely, right? There's been I can't remember, I think it was probably Sifted that was tracking it, but there's been a number of female partners that, made partner, probably spent a couple of years and then moved on. So why do you think this is happening, and how do we stop it?
Yeah, look, when a downturn happens in an industry, unfortunately, women are going to be some of the first to leave. Yeah. I'm not saying that, certainly if you're a mother, right, every hour of your day when, it matters, right, what you're doing. If you feel you're wasting your time, you shouldn't do it, right? And so maybe there's that type of stuff that goes on.
Sure.
But other than that, statistically, I'm pretty sure that the same amount of women that left it's commensurate to men, right, statistically, because it's just when it's a downturn, people leave.
Yeah. So proportionately similar numbers.
I don't know the numbers, but
sure.
Just by what I see.
But what gets reported is the women leaving.
Sure, because there are so few of them. Yeah. But fundamentally, VC is a boys' club, right? It's still very much a boys' club. I am an outsider to this industry. I came to this from the real world, and it's certainly for me, it's a huge source of motivation to demonstrate, that there is we all know that there's a million paths to VC. Yeah, everybody knows that. And in fact, coming to VC from the real world is usually better because at least, you have a little bit more of a pattern recognition there of what works and what is just never going to fly. And demonstrating that you're, as an outsider and as a woman, you can do better than some of these, traditional boys that have all been doing the same things. For me personally, is a huge source of motivation.
Yeah, I mean, we make a big deal on this podcast that we're not a diversity podcast, but we talk about it a lot because of the nature of the guests I had. In fact, the reason I launched this podcast in some ways was to give a voice to people that I wasn't seeing rather on other platforms, right? Whereas actually, when I looked around me in the ecosystem, it was, I was talking to female partners. I was talking to ethnic minorities, either as founders or as investors. Interestingly, I've got an Ghanaian Italian, now living in the UK, founder coming on the podcast in a week or so. He's building a snacks business, but for kind of discarded food, right? Like, so all the stuff that never makes it to the supermarket shelves, right? Giuseppe Baidu. But, and his story is incredible, right? Like, and he talks about it in terms of he had to break in, right? Like he had to figure his way in.
You are, as a certainly as a woman, you will be an underdog for a long time.
Yeah.
Right. And it's harder, but again, I was at Goldman for a long time. It's not, it's a little bit better, to be fair, a lot better, but it's also not great. Yeah. You have to swim with the sharks. And so you learn how to manage the sharks. Right. And so
in my mind, if you have to fit in to get ahead, rather than bringing your own kind of dynamic to it, then essentially you and I'm not saying you're doing this, and I'm not even saying anyone's doing this necessarily, but it feels like in that sort of a sector, whether it's Goldman and actually whether it's VC, if you end up kind of diluting your own personality.
Oh, no, I agree. But that's why the culture you build, the firm that I've built is very different. We've always rejected the lone wolf, which is traditional in VC. We are very much, we own things as a team. You can do things differently in your team, but you have to realize that as soon as you walk out of the door, you're going to be swimming with the sharks, right? And so you have to manage that. And I think that I've seen over the years women find harder.
Interesting.
But some men find it hard too. It's not generalizable.
Yeah, I'm definitely of that nature. Like I'm a collective kind of person. I don't like sharp elbows. I don't like I don't like that kind of killer shark kind of mentality. And this is one of the reasons, by the way, having thought about it long and hard, like multiple times, I like every day I come up with a different reason why I either should or shouldn't raise a fund or should or shouldn't invest, because I look at the industry and I love the industry, but equally I sort of look at the industry, I'm like, but I can see the flaws because I'm somewhat outside
Sure,
it,
but
right?
you have to, you're not going to get away without having sharp elbows. You're not going to get away without being, on the piece all the time.
Yeah.
But it doesn't mean that in your own house, you can have slightly different rules.
Yeah. I think that's definitely a good way of thinking about it, because I think, if you can come home and kind of kick off your slippers, as it were, and put your feet up and have a cup of tea, I think that that is probably the way to approach it. So look, just as we kind of wrap up, I have a couple of sort of light. Well, one of them isn't that light, maybe, but a couple of questions to finish off with rather. So what is one thing that you have a contrarian conviction about from any area of life, whether that's work, politics, socially, or at home?
Well, I'll continue on this topic of, the women and stuff, right? And it's funny how I still cannot find anyone that would agree or, at least talk about this. But I've been convinced for a long time that the best way to make sure that women stay in a career is to actually put the light on the working husbands. Does that make sense? Or partners, right? Because it is actually really hard. I've seen it, we've been a dual career couple for almost 20 years. But my husband had to sacrifice and I have to sacrifice, right? And so the vast majority, but like 80 or 90% of the senior men I've worked with over the years had stay-home wives.
Yeah.
Yeah. You might have to pay the price later in your life.
Sure.
But but it's kind of not a fair play.
Yeah.
Neither for the
For the wife or
for
the
wife
husband.
or whatever. You
Yeah.
could be in a different type of relationship.
Sure.
But and it's funny how, and of course, why that doesn't happen is because 80+% of the people that are in powerful positions have a non-working partner. But there are enough of those, that, and it has to be a partner with a proper career, not like someone that works 4 hours a day.
Yeah.
But that, is something that I've always been very passionate about. And, and I've seen, over the years, how working sort of husbands or working wives have been able to build very strong teams. Because you kind of, especially the women around you, will know that you understand them much more than somebody else. And it's such an easy little tweak, but it's kind of not applied anywhere.
It's so one of my very close friends is an incredibly senior, she's a senior kind of partner lawyer, and her husband was in banking. They have a family, and like it's a really interesting dynamic between them because they are very much like they're never in the same place at the same time.
Yeah, like us.
Yeah,
yes.
but they figure out how to do the things, and I constantly kind of she'll message me and I'm like, where are you? And she's like, oh, I'm on my way to Austria to go skiing. I'm like, weren't you just skiing 6 weeks? She goes, look, this is literally the one, like going skiing, and whether it's going skiing or something else, but it is going skiing in their case. This is the point where we can come together as a family and spend the time and actually be ourselves together, right? With all the manic stuff, and she sits on boards and she does this and she does the other. She's running an incubator. But they made it work because they both bought into the fact that they were both going to be career people, right? Now, I know that she loved having her kids, and I know that she spent the time and all the rest of it, but she did go back to her career. And I would agree, like, it takes two to tango, right? In any partnership, in any marriage, in any kind of relationship of any kind of substance, you both have to work at it.
Sure, which is why for an ambitious young woman, there's only one decision that matters: who you're gonna, be in a relationship with. Because if that doesn't work, then everything else is not gonna work.
No, look, I love that, and I think, look, I mean, as a guy, I think it's lovely to hear that, right? Because we, the old adage in English is, behind every great man is a great woman. But maybe it's time we start thinking about behind any great member of a relationship. I'm going to figure out a better way of saying it, but behind any great relationship, there's another person, right? Like there is always someone supporting that, and compromises to be made, and everything else. But I think that's lovely. I'm sure your partner will appreciate and love that you said that. And I guess finally, one question so that we can get to know the real you, although I feel like we've probably explored a fair amount of the real you as well. What is something that moves you emotionally?
I think something that is very rare in our industry, humility, which typically comes together with kindness, not always. But when you see that in our industry, it's so special. And I'm naturally attracted to those people because it is so rare.
Yeah. Arrogance has been the kind of, in a post-Twitter world, I think, arrogance has become...
Yeah, it seems to be the currency. Yeah. But it also usually leads to kind of emptiness.
Yeah. And a lack of empathy, and a lack of a lack of growth or growth mindset, maybe, right? I think that's equally lovely, and I will try and stay humble, which is difficult when you host a podcast, I have to say. But anyway, Irena, it's been absolutely wonderful speaking to you. For our audience, where can they find you online? Are you on LinkedIn, Twitter? Where can they find you on the internet?
I'm not on Twitter. Actually, the recent war with Iran was the first time, because at least at the beginning, there was still internet in Tehran, so you could kind of figure out. But it lasted for 5 days.
You said Tehran really well. What, like, do you have a Persian kind of...
Well, I lived in the Middle East, so
I
know a bit of Arabic. No, I think... No, I'm definitely not on X. I am on LinkedIn, or we have a website. There's still contacts there.
Yeah, we'll be putting the links in the show notes. But look, Irena, thank you so much for joining me. It's been an absolute pleasure.
Pleasure as well.